All right. Welcome to week 2, lesson 2, and it's getting more interesting and interesting by the day. And what you ought to understand about this whole thing is that it gets better, and what you could become is something very beautiful, something very big, and I am rooting for you. It might want to look a little bit difficult, but I'm encouraging you. Your questions, have them down when we are going through our live session. That is why it is a mentorship. That is why it is not a YouTube channel. You can even send in your email on questions. If I have to record something, if I have to recommend some links for you to study, I will do that. I will hold your hand through the journey and try as much as possible. Yes. So anytime, for example, you hear a terminology that is a little bit out of place or you don't understand, write it down, look it up. Thank God for Meta AI, or if you have an iPhone, if you type it in the chat and you do look up, it will quickly bring something you could read. That's one. All right. Yes. So moving on into today's episode or lesson rather, we are going into what we call understanding Forex terminologies: spread, slippage, and drawdown. All right. Now, why do we need to study this? Because before we execute a trade, we first need to understand some key Forex terms. These concepts, they are going to affect our profit, our losses, and our overall trading experience. I'm of the opinion that Forex journey should not be rushed so that you have a solid foundation. If we all came to the market with the expectation of making a lot of money, and some of us went in the wrong direction at first and then came back and calmed down and started again. And what you are doing right now is saving yourself the headache of having to go through all of that before you now arrive at even this short to be profitable trading. All right. So this is one of the lessons that is very important for us foundationally. So knowing them will help us trade smarter and avoid unnecessary surprises. I already mentioned that when it comes to Forex trading, it's almost inevitable that we are not going to lose. It's going to happen. But we will be ready and well armed so that we make the best of decisions when we get to that bridge. Let's get straight into it. So one, we're talking about spread and call that the hidden cost of trading. I made an example, I think, on lesson 1 of week 1 about how brokers make money from spreads. If you remember, right? The difference between what? Between the ask and the bid. I think we did that. So we are going deep into that right now. So the spread is the difference between the bid price, and the bid price is what buyers are willing to pay, and the ask price, the difference between the bid price and the ask price. Why the ask price is what the sellers are offering. It's how brokers make money, especially in commission-free accounts. So every time we execute a trade, we say the broker are the ones that provide the opportunity for us to use their tool in order to make money. It is expected that they wouldn't be doing it for free. In fact, if you register for a broker in the last 24 hours, for a good broker with good customer care and all that, they would have called you, give you advice on deposit your money. We are going to add you to a signal group. We want to help you. No, they are not helping you. They know that every time you place a trade, whether you lose or you win, they are going to make money off what you are doing. And it's not a bad thing. I mean, everybody should hit in this industry. There's enough money to go around. Usually, there are Forex accounts or broker accounts that are commission free. There are some that are not commission free. All right. So this is how brokers make money from the spread. And again, the spread is the difference between the bid price and the ask price. And we can refer to this spread in two. If I think you have to refer to lesson 1 of or lesson 2 of week 1 to remember when I was mentioning that when we trade the major pairs, the spread are a little bit different from when we trade the ones that does not really have volumes, right? So let's categorize these spreads into two. The first one is the tight spread. The second one is the wide spread. The tight spread simply means that lower cost, and you can see this whenever you are trading high liquidity pairs like our favorite Euro USD. Meanwhile, this week I'm trading Euro USD and it's been my best trade in some weeks. A lot of pips in. Yeah, I just had to put that in there. All right. Then we have the wide spread. Wide spread means higher costs, and you can see this on exotic pairs. These pairs are not very popular, and usually they are the cross of dollars and a third world economy like the USD and the South African rand. All right. So for example, if you should already log in your MT5. On your MT5, when you go to the base and you see quotes, when you see Euro USD, is written like this. You have where there is a percentage, there is the Euro USD, and underneath there is time, right? As at the time of this recording, let me take a screenshot and put it out for us. As at the time of this recording, beside the time you can see 4. That is the spread of Euro USD, and it fluctuates. It goes down to 3, it goes down to 4 sometimes. But I think I should do a screen recording right now so that it correlates with what I'm going to show on the screen. So Euro USD, as at the time, you see Euro USD underneath there is time, and in front of it is the spread. The spread here is 4, and look at the other pair. Euro JPY has 11. Bitcoin own spread they are calculated differently. It has about 3,176 spread. So you can see different spreads like that. So the reason why Euro USD is now very low is because it has high liquidity. People trade it a lot. It's very popular, and it's also a major currency pair. So that's that on spread. So for example, if Euro USD bid price is 1.1000 and the ask price is 1.1002, what is the spread here? The spread is just 2 pips because they will be quoted side by side like that. Let me try and do another screen recording on my Euro USD. I have on this small account that I'm trading, so you see the charts. Let me go to 1 minute time frame. You can see 2 lines, right? You can see there's a line above and there's a line below, right? The line above is different from the line below. The difference between the two, that's the bid and the ask price, right? Remember we said that the bid is what the buyers are willing to pay, right? That's the one above, and the one below is the ask. That is the price that the sellers are willing to offer. The differences between these two is what we call the spread. Meanwhile, there's a news coming out soon. I'm hoping that this drops. I have my stop loss set. I can't wait to get into practical with you guys, but let's get back to it. All right, so this means your trade starts with a small loss equal to the spread amount. Immediately you press your buy or sell button, you will first see a negative because of that spread. So if you're in a currency pair, you're trading currency pair that has a wide spread, immediately you enter the market, you first be in a negative. If it now goes your way, it now comes to you. So that fee goes to your broker. So why this matters is that a lower spread means cheaper trading cost. Why spreads can then also spreads can widen during high volatility. If the news starts now, the spread, they can increase the spread, they want to make more money, or when the market closes at night or it's just opening and the volumes are down, the spreads can expand. To give it a shot, at around 10 p.m, 10:30, 11 p.m. Nigerian time, if you should check the same Euro USD, you will see that there is a wide gap at that period. All right, so let's move to the second one, which is the slippage. Sorry, this episode is going to be a little longer because I needed to explain some things, because these terminologies sometimes are not they're not just something we are used to, so explaining them or trying to grasp them can be hard. But like I've always said, Don't think hard on these things. Just listen to it with an open mind. Let it just sink in. By the time you go over it 2-3 times, you become familiar, and then you read materials about it, and then it becomes a part of you. All right. So slippage, let's call that when you don't get the price you expected. Just like the word slip, if something should slip, like a mistake or an unusual something, right? So for this purpose of this lesson, slippage happens when your trade executes at a different price than what you clicked due to rapid market movement. Thank God for technology, but sometimes when you execute, it doesn't just go at the speed of light and just go at the speed of light for everybody and everybody is happy and all that. Sometimes there are your network could cause it, technological issue could happen, and then you click, you are buying at 1.1000, but your entry price recorded something higher or lower, right? So we could have what we call positive slippage or negative slippage. That's why you hear some brokers saying, some traders saying, I don't like that broker, they don't do this and they don't do that. It could just be slippage going on, but for some broker it could be more recurrent, and that's a red flag. When we are choosing a broker, we want a broker that at least slippage is very well reduced when we are in the market. All right, so for positive slippage, you get a better price than expected, which is good. For example, if I want to buy at 1.1000, look like I click buy and it goes down a little to maybe 1.0999 or something, then it now comes my way. It's still good for me. But if I sell at 1.1000 and my sell goes up to it executes me from 1.11, it's too much. Or no, that's too much. 1.1001 or something, it's negative slippage. That means you got a worse price, which is more common to get a worse price. So example that is written for our study is, you place a buy order at 1.2500, but due to fast price movement, your broker executes at 1.2505. That's extra 5 pips of slippage. The whole story, whether positive or negative, is that the market was not executed at the point that I clicked or placed my order. So how do we reduce this? Number one, we are going to be trading during high liquidity hour, mostly between London and New York session, is how to reduce slippage. Then number two, we are going to be using limit orders instead of market orders. If you remember, we spoke about market execution, that there are the market execution where you instantly order the market to do something immediately, whether buy or sell, or set at a particular price and tell the market when you get here is when you should do a buy or a sell. That's what we call limit orders. So when you already have set it ahead of time, there is no more slippage. The trade has been recorded, so when the price gets there, it triggers it and goes your way. But as that also has its downside, but it reduces slippage. But sometimes, most of the time, we just execute our trade instantly. All right, so let's move to the third one. The third one is a slang that you will hear a lot of traders talk about. Is drawdown, which means measuring your trading losses. You know, I've always told us that in trading, one of the most important things for you is calculation, not really mathematics or whatever, but at least to know what you can lose or make before you even enter the trade. So one of the terms we use is drawdown, and drawdown refers to the percentage drop from your highest account balance to your lowest point before recovery. Is a way to measure risk and how much your strategy can handle losses before bouncing back. So by the time we start executing trade and you understand the basics, the first thing is to develop your strategy, because I will show you mine as a courtesy of you putting up for this mentorship. And when everybody will, you can adopt a trading concept, but you're going to have your own trading style eventually, what works for you, right? Now, when you have a strategy, sometimes the market is not just going your way. It doesn't mean that, especially if that strategy has been working and then it seemed to stop working, it just means that the market was not conducive for you at that period. So when you now calculate your drawdown, if your drawdown is less than 40%, then it might signify that your strategy was not really good at the first place, right? But even at that, jumping from one strategy to another strategy is not the best for a trader to do when such happens. Good risk management, we'll talk about risk management further in the mentorship, but that is why we need to know your drawdown. You need to be able to ascertain, oh, this is how much I'm losing currently and in percentage. So how do we calculate this thing? So for example, you deposit $1,000 in a trading account, then your balance drops to $800 due to losing trades. Your drawdown is 200 divided by the 1,000 times 100, which is going to give you 20%. Why does this matter? It matters because one, high drawdown means risky strategy, and two, keeping drawdown below 20 to 30% is safer for a long-term success, because we are not just here like the gambler to just carry some money and run. We are here to build the money consistently over time. So let's bring it all together. The spread affects your cost per trade. The slippage impacts your execution price, while the drawdown helps you manage risk. Understanding all of this concept that we've discussed in this lesson is going to make you a smarter trader for sure. Trust me, there are a lot of people that are already executing trades right now that does not even know what slippage means, that does not even know what spread or how drawdown. Some people refers to the how much they lost as the drawdown, which is not the right word to use. Drawdown is calculated in percentage. So by the time we start placing trade and you pay attention to all of this, you would be able to be in control of your trading journey. And with that, we have come to the end of this episode, or this part of the lesson. The next one is going to be how to read candlestick charts. I am so excited about this one. This one I might have to record me on the big screen showing you how to do that. I really appreciate you. I root for you. Don't give up yet. You are just starting. There is nothing to even want to give up about. Your questions, have them sent to me by email, and then get ready. At the end of the 5th lesson of this episode, we are going to have our live session as well. I hope you are getting a hang of it, and very soon it will all make sense. I'll see you on the next one. Cheers.